Good morning, friends. So let us start discussing the case scenario based MCQ questions given in your institute website. Okay, there are 56 case scenario based questions. We will discuss it in parts. So we'll start with question number 1 here. Okay, case scenario number 1. Equity researchers have estimated the rate of returns for stock A and stock B and market portfolio under each state of economy is as under. Okay, economy given various scenarios, boom, okay, normal and recession. Probability given 0.3, 0.4 and 0.3, and return of the stock for respective scenarios given, and market portfolio is also given. Now, the risk-free rate of return is expected to be 8%. The covariance between stock A and market is 122.7, and the covariance between stock B and the market is 125.4. Assume that the CAPM framework is valid in this market, and we have been asked these questions. See, question number 1, the expected rate of return for stocks A and stock B. See, many of your portfolio management chapter, I already told you the expected rate of return and required rate of return are interchangeably used. They have not been properly differentiated. But this question is a classic example where they have given you clear demarcation between the expected return, the required rate of return, that is CAPM or SML return. Okay, what is the difference between SML return or the CAPM return and expected return, mean return, and okay, under or overvaluation based on this return. Everything they have clearly given. So this is a very good quality question. Okay, important question. Now see, expected rate of return for stock A and stock B. See, is weighted average return of this stock. Okay, you have to do weighted average return because here probability given, probability weighted average return you need to find. For example, for stock A, what you should do? 16 into 0.3 plus 14 into 0.4 minus this plus becomes minus because this is negative return, minus 9 into 0.3. Okay, this you'll get 7.7% for stock A. Now, for stock B, you have to find out now. See, very simple. For stock B, 19 into, okay, this 19 into 0.3, 16 into 0.4, minus 7 into 0.3. How much is that? 19 into 0.3, okay, 5.7 plus 16 into 0.4, that's 6.4, minus 7, 7 into 0.3, minus 2.2. How much is that? 10%. So this is the expected return, okay, which you call as mean return. So A bar is how much? 7.7%. B bar is, okay, mean return of this is 10%. This is the solution, 7.7 and 10%. Are you all understanding? Next, question number 2. What will be the variance of the market portfolio? Okay, the variance of the market portfolio can be found out like this. See, the probability, and you have been given return, that is I call it as X, then X minus X bar, okay, then you have P into X minus X bar the whole square. Like this you can, okay, open up the column. Probability 0.3, 0.4 and 0.3. X, you have 3 years of return. See, very simple. Market portfolio, hence I consider the market portfolio RMS X na. So 18, 15 and minus 8. So 18, 15, minus 8, you can put it like this, and you have to first find out what is the X bar or RM bar. In this case, what is the average return from the market? So 18 into 0.3, just like you computed for stock, 18 into 0.3, 18 into 0.3 plus 15 into 0.4, that, okay, and 8 into 0.3, 0.4, very minus, can get it as 9%. Are you all understanding? So average return of the market is 9%. Then you have X minus X bar. Okay, 18 minus this number. Then 15 minus 9. How much is that? 6. Then minus 8 minus 9. You get minus 17. Like this, you will get X minus X bar. Then you have to, okay, square it up and then multiply with probability. Are you all understanding? So X minus X bar the whole square. How much is that? 9 into 9, 81. 81 into 0.3. 81 into 0.3. 24.3. Memory plus, okay, 24.3, again just write it out, 36 into 0.4, 36 into square is 36, hence I do it, okay, 14.4, then you have 17 into is equal to, how much is that? 289 into 0.3, probability if you multiply you will get 86.7, okay, that also if you put you will get 125.4, this I call it as market variance. If you take a square root of this, you will get the standard deviation. Okay, question is asking about variance, so 125.4 is the solution. Are you all comfortable? Next, question number 3. What will be the beta of stock A and stock B? See, there are 6 formulas for beta, I told you. 3 under correlation method, 3 under regression. So now, what is the formula they are using now? Okay, here covariance, based on the fact you can understand, here covariance of stock and market given. So for stock A, if you want to find out the beta, it is nothing but covariance of A and the market divided by what? Divided by sigma m square. Okay, sigma square m, which is nothing but the variance of the market. So you do it, covariance of A is how much? 122 points, some number given na, the question 122.7. So 122.7 divided by 125.4. Variance of the market, just now I found out as 125 points. So 0.978. Okay, 0.978 I get. Then, okay, covariance of security B and market is given as 125.4. The same as variance of the market. So the beta is nothing but 1 because the numerator also same, denominator also same. I did not compute. So 0.9785 and 1. C is the right answer. Are you all understanding? Next, question number 4. Required rate of return of stock A and stock B. Now they are asking clearly required rate of return, which is nothing but CAPM return or KE as per CAPM. SML, securities market line. Okay, graphical representation of the CAPM. That is what they are testing. Now, what is this? Beta in the RF plus beta into RM minus RF. You already know that. So here RF is 8%. For stock A, what will be the required rate? Okay, RF plus beta is what? 0.978 into RM is 9%. We know when you take RM, you should take the mean average RM. What is that? RM bar 9%. We calculate in the first step. Agreed. So 9 minus 8, which is 1. So 1 into 0.978 is 0.978, 8.9785, 8.9785. This is the stock A's required rate of return. Come to stock B. Stock B is same, the 8% RF plus beta is 1. RM minus RF is also 1, which means 8 plus 1, 9%. So 8.9785 and 9, this is 9875. This should be the answer for 4. Okay, you see here they have given they are playing with the numbers 8.9785. Here it is 8.9875. The right answer is 9785. A should be the answer. Just check it. Okay, once we can check it out. What is that? Case scenario number 1. Okay, we have yes, this is the solution. Okay, A is the solution for question number 4. Next, the question number 5. Which of the following statement is correct for purchase or sale of stock A and stock B? See, now for stock A as positive alpha, stock B as negative alpha. By alpha here, okay, you can easily calculate the alpha, Jensen's alpha. Here you are, if you are trying to, okay, find out the performance evaluation. Jensen's alpha, okay, it is nothing but the actual return or the mean return minus the required rate of return. If actual return is more than the required rate of return, security under or overvaluation of the security based on expected return and the required rate of return. I told you when expected return is more than, see, this is expected return, return. If it is more than required return or KE, this is known as KE. KE means required rate of return. If expected return is more than required rate of return, which means security is giving you more, okay, or expected to give you more than what you require, which means you tell me it is undervalued or overvalued? Undervalued, because expected return is more than required or undervalued. If required rate of return is more than expected return, which means you require more than what is security is giving, which means the security is overvalued. Are you understanding this? I explained in the portfolio management here. See, in this case, okay, if expected return more, now the security is having a positive alpha. The security is having a positive alpha. It is generating a positive alpha more than what, okay, is required by the investor. So what is here happening? Now very simple. Stock A is positive alpha. Very simple. Here I will write it down. Here expected return, okay, and required return. Now I have stock A and stock B. Tell me children, for stock A, we just computed required expected return for A and B as 7.7%. 10%. In the first step, expected mean return we computed. Required rate of return also in the step 3. The question number 3 we computed. I think required rate of return was how much? See here, A and B. Okay, 8.9785 and 9. So let's just write it. 8.9785 and 9%. Are you all comfortable? Now compare under or overvaluation, under or overpricing. You can compare. If expected return is less than required rate of return. See, required rate of return is more. Security is not satisfying the requirement. Hence, it is overvalued. You should sell the security. So, overvalued. Here it is expected return more than required return. Hence, security is undervalued. Like this, you need to segregate. Here, we will see, which means here undervalued. Now, it is generating expected return more. Then the alpha is greater than 1. Positive. Alpha is positive. Here, the alpha is negative. Okay, stock A has negative alpha while stock B has positive alpha. This means stock A is overpriced. Okay, this is the overvalued, and stock B is underpriced. Therefore, sell stock A and purchase stock B. This should be the correct answer. Are you all understanding? Very good quality case study. I would say this is very important to understand the difference between expected and required rate of return and the under and overvaluation based on expected and required rate of return. Very good question. Now, next, take case scenario 2. This is a very simple and straightforward. Anyway, I will discuss within a minute and then move on. Steady Mutual Fund has the following assets in schemes: Star Gold at the close of business on 31st March. Okay, they have given 4 companies here, number of shares and market price per share. Total number of units also given for this scheme. The scheme has accrued expenses of 2 lakhs and liability of 2,50,000. Put together 4,50,000 of the okay thing liability. Then you have gross value of Star Gold. Okay, in the gross value, net assets value, when you are computing, you will find out the gross market value. Then you will reduce the expenses. Here, the gross value now without reducing the expenses. So simply you will value these shares in the market on the market price. So market value. So 20,000 into 25, 30,000 into 350, 38,000 into 290, 50,000 into 400. Like this, you will find out the market value of the investments. How much it comes to? See, very simple. I can just calculate 20,000 into 25 lakh, then 30,000 into, okay, then 38,000 into, how much is that? 52. Recall again, 42, 420 lakhs 20,000. So 420 lakhs 20,000 should be the solution. Here it is. Okay, 1B is the answer. Next, total net value of the scheme is how much? Now, just remove the total expenses. How much you have to? 4,50,000. Just remove it. Okay, 420 lakhs 20,000 minus 4,50,000. Or 415 70,000, which is 415. Okay, 415.7 lakhs. Next, NAV per unit. Very simple. Whatever is the net assets value divided by total number of units outstanding. 20 lakhs I saw, I think, and you will get 20.785. This is the answer. Are you all understanding? Shall I move on to the next case? Okay, case scenario 3. Mr. X, an investor, buys the stock of WBL Limited worth 21,60,000 due to very strong fundamentals. Since last 3 months, the market sentiment is weak and witnesses significant volatility and considered to remain weak for about the next 3 months. Keeping the mind volatility in the market, Mr. X is planning to hedge his portfolio in the futures market. Okay. Now, the beta of WBL stock is 1.3 and the current value of Nifty is 2250 and 3 months future is selling at this price. The current market price of WBL stock is 240. Each Nifty futures can be traded in 240 units of 240, which means this is the lot size. Lot size is given as 240. See, assume there are no transaction M2M. Now, number of future contract to buy or sell to hedge WBL stock against expected fall in the market. See, if you have bought in the cash market, you have 2 markets available: cash market, future market. If you have taken a buy position in the cash market, which in this question is, so you should take sell position in the futures market. What they are asking, how many contracts you need to sell in the futures market. Now, for that, first you need to understand what is the value of the exposure amount to be taken in the futures market. So, future market value, this is not fair market value, FM mean future market value is equal to cash market value into beta. This is what I told you now, you will consider the beta. So, what is the cash market value? 21,60,000 is the cash market value. Beta is 1.3 or 1.4, 1.3. So, tell me children, in futures market to hedge a cash market value of how much? 21,60,000. How much is to be taken in futures market into, okay, 1.3. How much is that? 2808. 2808. This is the 28 lakhs 8,000 is the amount, okay, to be taken, amount of position to be taken in the futures market. Now, this 28 lakh 8,000 is a combination of 3 things. Very simple. The 28 lakhs 8,000 you got now. Okay, this you need to take now. In the futures, okay, you will have number of contracts. Now, I write it as C. This only you don't know, you need to solve. Okay, this into multiplied by each contract will have specified number of, okay, the shares. It will be bundled into these many shares. Are you all understanding? Futures will not available for one single share. It will, the lot size will be there. So contract, number of contract into lot size. In this case, it is given as 240. Are you all understanding? Into the futures price. Futures price, okay, which you take position today, which means the futures price today they have taken 2310. I think I'll just confirm 2310. Yes, 3 months future is selling today 2310. 2310. This, okay, you will take the position. So this is futures price 2310, which means very simple. The value should be equivalent to 28 lakhs 8,000. Okay, you need to find out the contract. Lot size is here. Future price is there. Very simple. So contract is equal to what? 28 lakh 8,000. Number of contracts is 28 lakh 8,000. The value divided by, okay, the lot size, which is 240, into futures price, which is how much? 2310. Okay, if I solve this, 2808 divided by 240 divided by 2310, how much I'm getting? 5.06. Now 5.606 now, you need to take 5 contract position, 5 contract or 6 contracts, doubt will arise. Now see, based on the requirement, you need to see here. You see, to get a perfect hedge, this I call it as perfect hedge. Why? Because cash market value into beta times the cash market value. So this, to get a perfect hedge, you need to take exposure of 28 lakhs 8,000. Okay, you need to make perfect hedge now. This much you need to take exposure. Here what they say, you got 5.06. You can either take 5 or 6 now. Okay, 5 is the nearest number to this. So I'll take 5 as my contract. Are you all understanding? So here in the cash market, I took a buy position. Now futures market, I'll sell how many contracts? 5 futures contract. Are you all understanding? Because it is nearer now to perfect hedge. So I will take 5 futures contract. Next, if Nifty index falls by 10% from 2250 to 2025 and WBL stock falls to 212, what will be my net gain or loss if portfolio was hedged on Nifty future? Okay, net gain, okay, these are all the option given. Very simple what they say. This is my cash market position, futures market position. First of all, in cash market, they said that you would have taken a position of, okay, 21 lakh 60,000. If 21 lakh 60,000 is the position taken in the cash market value, now how many shares are, okay, currently the spot price is how much? 240. So 21 lakh 60,000 divided by 240 if you do, you will get 9,000 shares, which means you have taken position of 9,000 shares. You have bought 9,000 shares. They did not mention the number of shares, but they've given the spot price. They have given the total cash market value, which means 9,000 shares you have taken by position. Okay, now this is the position. At what price you have taken? I call at 240. This is what you have done in cash market. Come to the futures market. You have sold futures. How many futures? 5 futures contract. Okay. At what price? Futures price 2310. This is what happened now. Now you will compute profit or loss. If, see, index fall by 10% and index came to 2025 and the stock also falls to 212. Two things happen simultaneously here. One thing is to be observed here. Here they have mentioned Nifty fall by 10% is 2025. This is Nifty and not Nifty futures. Are you all understanding? Two different things. Nifty future. Just like you have stock future, you will have index future. And the index fall need not be same 10% as the underlying index. Are you all understanding? It may be different, but we will assume lack of clarity is there. Okay, like this one question is also in the descriptive part also institute. Okay, the past MTP, they have given one question. So based on that, we'll assume that, okay, the same rate will continue. The same, okay, the percentage will continue for Nifty futures, which means Nifty falls by 10%. Now, Nifty futures also will fall by that rate. That is what is the assumption, which means the 2025, okay, convergence, a concept called as convergence, when on the maturity date, the spot Nifty as well as the future, the price will be same. That is the assumption. So 2025 will be the Nifty futures price. So futures, you have sold at 2310. You are buying at 2025. Are you all understanding? So 2310 minus 25. What is that? 285. So this is sold at a higher rate, bought at a lower rate. 285 into number of contracts 5 into, okay, the lot size 240 per contract. Now how much is that? 285 into 5 into 240. 3,42,000. This I make a gain in the futures market. Now come to the cash market. Cash market, you had bought the shares at 240. Now the share price became 212, which means here you bought at 240, selling at 212. Gain or loss? Loss. How much is the loss? Okay, 9,000 into 28. I think yes, 240 minus 28. So 9,000 into 28 is the loss amount. 2,52,000. Now tell me, children, 2,52,000 is loss, 3,42,000 is the gain. Okay, net gain of how much? 90,000. Are you all understanding? Is the solution. Next, question number 3. Okay, I'm just saying this. Now, question number 3. If Nifty index rises by 6% from 2250 to 2385 and WBL stock rises to 255, what will be the net gain or loss when portfolio was in hedge? Okay, this portfolio, what is that? Is was unhedged. I think this is unhedged. What is the understanding? If Nifty index rises by 6% from 2250 to 280 and WBS stock rises, what will be the net gain or loss? Was okay. This I would say this is when portfolio was hedged. This is what I should say. I think this is wrongly given here. We will see. It is unhedged. Okay, just simply was hedged when portfolio was not hedged. I'm not getting the clarity. Some printing mistake is there. We will try. Okay, we will see how it is solved. See, very simple. You have cash market and futures market. Okay, in cash market, it is 22502 2385, right? So 2385 is the index. So futures market, you sold at what? 2310. You are buying at what? 2385, which means you are sold at a higher lower rate and buying at a higher rate. Here I will incur loss. Loss how much? 2310 minus 285. Okay, or 2385 minus 75 is the loss. Okay, 75 into 5 contract. Okay, the 75 into 5 into 240. How much is that? 90,000. This is the loss in the futures market. And cash market, you have 9,000 shares into, okay, you bought the share at 212 and now it became 255. So 255 minus 212, how much is that? 43 into 9,000. This is the gain, okay, into 43, 3,87,000. So 3,87,000 minus 90,000. What is that? 255, sorry, 255 minus 240. Sorry, this is 255 minus 240. That is what is spot price. 250 minus 240. How much is that? 50. So the gain is only 15 into 9,000. How much is that? 1,35,000. Okay, sorry, 1,35,000 is the gain. This is 15, just 15. Okay, I thought 212 was the spot price. So 1,35,000 is the gain and loss is 90,000. So 1,35,000 minus 90. How much is that? 45,000 is the net gain. Are you all understanding? Okay, 3B should be the solution. Let's check it. And okay, case scenario 3 and 3B is the solution. 45,000 they have given as the solution, which means here, okay, when the portfolio was hedged, this is what is to be taken, because what will be the, if it is unhedged, then okay, we cannot say it as gain. Nah. Anyway, we had to compare the spot and cash market and future market, and we will take it as hedge. Okay. Now, so from case scenario 4, we will discuss in the next video. Thank you.